Yes, I think we're fine.
Okay, let's get started. So thanks guys for coming and joining us on this mini budget update. As we were just chatting at the beginning with Rob, it's been a bit of an interesting period. We're not very used to seeing things announced in budgets as things that we're assuming will happen next tax year and then having them rode back on, but we did have a U-turn yesterday morning, I think, on the 45p rate disappearing. So I think probably what I should start with is we need to take whatever we say today as being what's happening right now, but things can change, and as we're starting to learn, do change with this government a bit faster than we're used to. So that's one of the reasons for having a live chat today, was to allow you guys to ask us some questions about what we think is going to happen and what we know up to a point is going to happen, and what we can help you with, because we know that it's quite an uncertain time, and uncertainty is not nice for business owners. We don't like it. We like to be able to plan ahead as accountants. We like to be able to guide you through the rules. If we don't know what the rules are, that's slightly harder. So let's start with some of the questions that we had sent in before today, and then if you guys who are in the room live have got anything they want to add, we'll just open up the floor to some Q&A. But I think, Ali, we had a few questions that people had asked us to cover. So we'll do those, we'll pop them into this recording. For those people that haven't made it today, we will send the recording out straight afterwards so that you can listen again, and we'll probably pop it up onto social media too. So just be aware, if we're having a chat about your personal circumstances, you might not want to share too many details that you wouldn't want to be in the public domain. Okay, Ali, let's get started.
So the first question we've had is, should I put off drawing anything this year in order to draw it next year?
Okay, so this is a conversation we've had quite a lot in the last 4 or 5 days, isn't it?
Yeah.
About taking money out of businesses. So this is really for limited company owners. If you are used to drawing dividends and salary from your business in order to make up your personal income, what should we be thinking about differently right now? So the reason this question is being asked is because the year we're in right now, this is the tax year to the 5th of April 2023, we've actually got a higher dividend rate than we think we're going to have next year. So from the 6th of April 23, we're going to see the extra 1.25% that's been added onto the dividend tax rate for this current year taken away. Now, I don't think that's going to change. The connection between the increase in national insurance and the increase in the dividend tax rate, since we're pretty certain this national insurance health and social levy is not going to appear next year, I think it's fair to assume that the dividend uplift of 1.25% will also disappear. So I think you're fine to assume that if you take dividends this year, you're going to pay more tax on them than if you take them next year, and it's 1.25%. So we did do a couple of little workings on that, didn't we?
Yeah,
just fill that in.
So what we're basically saying is, for every £10,000 in dividends that you could take this year, you're paying an extra £125 in tax. So hopefully that can put it into some sort of comparison for you out there, for those of you out there that are thinking of taking dividends this year, and whether to consider moving them to the next year.
So before we knew what was happening yesterday, we were going to be suggesting to clients that actually it would be useful to move drawings into next year, because you also don't have the additional rate of tax. So this is in the UK income tax system, we have basic rate of tax, 20% tax this year, next year 19%. Then we have the higher rate of tax, what's often referred to as the 40% tax band. And then above that, we've got an additional rate. That's the 45p rate, which you'll have heard the government talking about, which was going to be taken away, and we now believe is going to stay in place. So there's a little bit less play now between this year and next year. Those 3 rates also apply to dividends. So there are 3 dividend tax rates, and we assume that is going to stick. So we're going to continue with 3 rates, just without the extra 1.25%. So slightly easier to understand the maths between this year and next year, but there's still a small tax saving, £125 for every £10,000, to be made by moving some of those dividends up into next year, if you're able to do that. And that's where there's a bit more of an art to the way that we think about taking out money from the business, because yes, there's a tax saving to be had, but that might also have implications for other things, like if you're thinking about having a mortgage. And I think we had a question about mortgages.
So yes, got someone asking, I think I'm going to want to apply for a mortgage next year. What do I need to consider when I'm thinking about how to take money out of my business?
Yeah, okay. So these two things really interact. So as accountants, we're often thinking about how to save you guys tax, but we have to be a bit careful about that, because the flip side might be that you're looking to borrow perhaps in the next 2 to 3 years. And what we don't want to do is mess up your ability to borrow by having a drop in your income, because we're trying to play off the tax bands, that would result in a problematic looking income statement for your mortgage broker or lender. So when we're thinking about mortgages, we're normally being asked to provide statements of the last 2 financial years. Usually some lenders ask us for 3 years. Normally it's 2 years at the moment, isn't it?
Yeah.
So if you're thinking you might want to be borrowing, maybe not right now, but a little bit further on, you could end up in a situation where you've done something kind of clever to save £125 of tax, but suddenly you're missing out on Emma, sorry, darling, could you just mute for a second, because there's quite a lot of feedback. Perfect, thank you. Mortgages. If we end up with a period where you've got a drop in income, and then so it was looking better for the 21, 22 year, then the 22, 23 year drops out, and you don't have time to do the next tax return, you could end up being offered either a worse rate or lower amounts of borrowing, just because you were playing a little tax game. So do bear that in mind. And I guess the thing to say there really is that keep on talking to your accountant. If it's not us, talk to whoever does look after you, or your financial advisor, just about what your plans for the future are, because you can end up, if you don't share all of those plans with your advisor, you could end up doing something that saves you a little bit of tax but really messes you up later on down the line, because they didn't know you were going to think about borrowing. Alongside that, it might not be your first property, your first mortgage. It may be that you're having to remortgage at some stage, and the market is very shaky just now. We're seeing mortgages fall off the cliff, we're seeing offers disappearing really quickly, so it's a very uncertain place to be. You really don't want to be putting yourself in a position where you're going to miss out on a mortgage offer just because of that kind of salary dividend game that you might be playing. Yeah.
So fantastic, thank you for answering that, Tory. So the next one I've got is still talking about earnings. From a director of a company, what salary should I be paying myself now for this tax year?
Yeah, okay, so this is the strangest tax year I've ever lived through, which is saying something. So we've never before seen national insurance rates being changed mid-year. I don't remember it.
No, I don't remember it either.
For it to change twice in one tax year is something else altogether. You have to really be very grateful to your software, payroll software people, who are right now in the background rewriting a whole load of stuff that they rewrote for July. So what's happened with national insurance is we increased the rate by 1.25% from July, and we're going to decrease it back to where it was previously on the 6th of November. What that means is that directors who have a slightly different way of having their national insurance calculated, so directors are allowed to calculate national insurance on a cumulative basis, the same way that we do tax. And that's different to your employees, who have a 1/12 of their national insurance band every single month. So the way your employees are being worked out for national insurance will just change on the 6th of November. And that's pretty straightforward. Your software should just deal with that. So you don't really need to worry too much about it. If you're a director, the amount of your national insurance band has kind of gone up and down. So we're going to get a rate given to us by HMRC They just haven't done it yet. So they've done it for the last change, the July change, but they haven't done the November change yet. So we're just keeping a little eye on that coming out from HMRC. So my advice is don't change anything. Whatever your director's salary rate has been set at for this year, just sit still, don't make any changes, and let's just wait out the next couple of months just to make sure everything settles down and we do get the rates we're being told we're going to get. Because the lovely thing about being a director on a payroll is that you've got until February, March next year to make any of those last minute changes to get the best out of the cumulative tax year. So you could pay yourself a little bit more in your final March payroll, and it won't have a negative effect on your national insurance because you're allowed to use it cumulatively. If you are an employee, you don't want to do that because you just get a 12th in each month, and you could end up paying lots of national insurance in the last month because you go over a 12th of the total. But as a director, you can do that. So my advice is don't change anything, just sit still, it's all going to be fine. Do talk to your accountants again if you think that you might not be being paid a very tax efficient amount through your salary. You know, if you're taking a big salary, sort of maybe like 30 or 40 grand of salary, and you're not taking dividends, you might want to look at that mix because there is a more tax efficient way of doing things. But don't mess around too much in the margins, is what I would say.
Yeah. So the next question then I've had is from an employer asking, what do they need to do about the national insurance change coming in November?
Yeah, okay, so you don't need to do anything really. There was in the last budget, pre the mini budget, there was this obligation to put the health and social levy wording onto your payslip for next year to explain to employees why they were having another 1.25% taken off them. So that was all written, and now we're taking it all apart again. So we don't need to do anything on that. Your payroll software, so all of our clients use BrightPay, but you might be using Zero Payroll, or you might be using some other payroll software. It should be able to handle all of these changes without any problems. If you're using a really old legacy piece of software, or perhaps you're using employer tools on the HMRC website, which is for smaller employers, just take a second look at the numbers as they come out in November, just to make sure that the right rates are being used. I think you'll be absolutely fine with all of the big boys. They'll have this absolutely nailed. It's just some of those older, maybe desktop payroll softwares that might not manage it quite so well. You don't need to say anything to your employers. It's just all going to come through in the to your employees. Sorry, it's just all going to come through in the wash. But you might want to have a conversation with them to say, you know, that you're getting a little bit less in your payslip just at the moment, but in November that's going to get just a little bit better. And again, if you're finding things like retention is tricky, it might be nice to talk to your payroll provider, your HR people, or your accountant and say, you know, what's that going to look like? Could we work out what that difference is? So at least I can tell my employees, I know, I understand that the cost of living is hard. This thing is going to change a little bit. You can expect a little bit more in your payslip. And it might just help with some of those relations.
Fantastic. So changing topics slightly, what's happening with corporation tax?
Yeah, what is happening with corporation tax? Okay, so we were told that there was going to be a rise in corporation tax from the 6th of April 2023 in the big budget, previous big budget. In the mini budget, that was scrapped. So what that means is that the 19% of corporation tax that you pay as small business owners if you have a limited company will stay the same for next year. This is absolute music to our ears because the change was very complex. It had lots of difficult calculations, and it was going to make it so much harder for us to do this sort of off the cuff. It looks like you should be thinking about X amount for your corporation tax. So that's good news. It's good news for small businesses. It means that you can plan forward, still working on the 19% corporation tax all the way through. And what that means is you don't need to think too much about the timing of things like big spends in your business, but we're going to come on to something about that in a second, because this year and next year are going to look pretty much the same. And I think we can assume that the government that we've got at the moment is probably not going to mess with that anymore. So I would say that one's pretty much baked in.
Fantastic. So if I'm planning to buy an asset, is now a good time?
Yes, generally the answer to that is yes. So we had a super deduction that came into play 18 months ago now.
Yeah.
The super deduction is a capital allowance that allows business owners to spend on plant, machinery and equipment, and a few other things, and we'll just talk about what's included and what's not included, but generally those sorts of things, plant, machinery and equipment, you spend £100 and you can claim £130 against your tax bill for that year. This is a really generous scheme. We don't see this kind of thing happen very much, and that is why, as it stands at the moment, it's due to be taken away on the 5th of April 2023. So from the 6th of April, there will be no further super deduction as far as we're aware. What that means is, regardless of what your financial year is for your business, so your financial year might span that period, the day that you spend that money does matter. So you can't say, oh, well, my financial year finished at the end of May 23 and I spent some money during that period, so I'll get the super deduction. Not necessarily true. The spending has to be done before the end of the tax year. So let's say 31st of March would be a sensible sort of cutoff point. So for example, if you're running a small business and your laptop's a little bit old, and you know you're going to have to replace them in the next 6 or 8 months, you definitely want to be doing that before the 31st of March, because you're going to get all of that extra saving off your corporation tax bill if you can get it done before the 31st of March. So you really want to be making the most of that. The super deduction is going to cover computer equipment, printers, fixtures and fittings. So that might be, you know, replacing your desk, buying new lamps for your office, that kind of stuff. What do people sometimes ask us is if it's included and it's not?
So quite often cars, motor vehicles gets asked.
Yeah, so unfortunately, no super deduction, even on electric vehicles. People often ask about that.
Yeah.
They don't come under this scheme. We were really hoping that the government might have pushed for some of that greener technology. They really aren't talking about that at all, these guys, so that doesn't come under it. Yeah. But there are some other bits and pieces that we've seen people do. So actually putting in an electric vehicle charging point does come under super deductions. So not the car, but you can do the charging point. So if you're thinking about doing that, you want to be thinking about getting that booked in really soon so that it falls under the this tax year.
Brilliant. And I think we had a slight note on that with regards to how much could people invest in a tax year?
How much can people invest in a tax year, Ali?
So the annual investment allowance went up to £1 million. They were bringing it back down. However, they announced in this mini budget that they would be extending it back up. So we've got a little bit more money there for people to play with. And that is an annual limit that you've got. So if you're considering, or in the past may have been considering, buying those larger pieces of plant and machinery or assets and thinking that it may have taken you over that limit, actually this is a good thing because you can buy more in 1 year.
Yeah, so it's good to see that there. Really make the most of it if you have the ability to do so. As I always say, never let the tax tail wag the dog for your business. So don't go spending money that you don't have on things that you don't need in order to make a tax saving. That's madness. It's got to be something that you do need in your business, but just thinking about the timing. So if if you're thinking maybe I'll push it a little bit further into the year, bring it back into this tax year, get the savings on it, and make the most of it that way round.
So the last question that I've been sent through is, are we going to be reimbursed for the 1.25% national insurance levy we were charged from July?
No, I think is the answer to that. No, I think the government are definitely seeing that as a little bit of tax that they've already tucked away and got out of people. They've taken the hit on doing that as a politically. I don't think they're going to give it as a hand back. So I think you've got to just assume that what's happened July, August, September and October with that extra 1.25%, that's gone. And I think while we're talking about that, it's worth just noting, because I know there's some confusion around this, that the 1.25% on national insurance disappears from the 6th of November. The 1.25% that was added to the dividend tax rate doesn't go until the 5th of April next year. So I'm suspecting some people might start thinking, oh, well, I'll just declare a dividend in December and I'll get taxed at the old 7.5% rate, which was the basic rate for dividends after the first £2,000, which is free of tax. You won't. You're going to pay 8.25% on that for the whole of this tax year. So it won't be until the 6th of April that 8.25% rate drops back down to the 7.5% rate that we had previously to now. That's a lot of numbers that we've thrown at you. When we finished today's call, we will just pop that onto a little brief table, so you don't need to remember all of those rates. But it's just worth noting that dividends declared in this tax year are the most expensive ones that we see coming.
So that was all the questions that we've been sent through prior to the webinar.
Yeah.
Have we got any questions from anyone here? Chandeep, you've raised your hand. Fantastic.
Go ahead and unmute yourself. Feel free to shout out.
Oh yeah, that was very well summarized. Thank you very much.
Oh, it's a pleasure.
Yeah. One question I have is, so I wasn't looking at the super deduction, but I've purchased a few assets recently. One of them is a Brompton e-bike. Is that covered?
Oh, you put me on the spot there. So it's an electric bike. I suspect it might be, but I tell you what we'll do is we're going to have a little look into the we'll look into the legislation.
Yeah.
And I'll drop you a note back if you're okay with me just dropping you an email. If you want to pop your email into your, so we've probably got it from the.
So we've popped, obviously, I've popped into the chat for anyone who is thinking of contacting us or wants to send any additional queries through to the accountant's email address, which is in the chat for everyone. But Chandeep as well, obviously we should have your contact details. If not, if you'd like to send an email through to that one, then we can contact you that way if you don't want to pop it into the general chat today.
And we'll also pop it into our follow-up,
yeah,
so that we can double check. I hate to say yes and then have to say no afterwards. I got caught out on the electric vehicles when they first announced the super deduction because they didn't give us any guidance, and we sort of, well, of course it must be,
yeah,
but it wasn't. So I don't want to get held to the wrong thing. But yeah, it's a really good question. It's those sorts of educations that are really interesting.
yeah.
Okay, brilliant. And then my second question is, seeing as we're in a constantly dynamic economic global situation, which at times is not helped by people who are changing the rules in our country, I wonder if now is a good time or a bad time to consider increasing prices in line with inflation and strategies to do so, because obviously doing it now before more people are struggling could be seen as advantageous, but doing it could also backfire and cause people to look at different suppliers. So are there any specific strategies around that you'd recommend, and keeping it low and then doing it later, or just doing it all at once and getting out of the way?
It's a really great question, and I think it's something that lots of people are thinking about. Would you mind just sharing what kind of industry you're in?
So it's web development, mostly around, being a freelance web developer. So, the kind of thing that would currently be about £60 an hour, that I would be looking at maybe increasing to 65 or 70, or actually looking at the inflation figure. But the rate hasn't really been increased over the last couple of years, which probably is an oversight.
Yeah, and I think that's what we're seeing for quite a lot of people who haven't done price increases over the last couple of years because it's been COVID, and that there's always a good reason not to raise your prices. Okay, the thing is, we are running businesses that need to be sustainable in the long run in order for us to continue to help people. And with small business owners, I see this so often, is that people get really, really het up about price increases, and they feel like every client is going to run away if they put 5% onto their prices. And what we see in reality is that because most small business owners really, really care about what they do, and they're really good at what they do, their clients actually love them. And you can put your prices up as long as you are looking after your clients really well, you're being authentic with them, and you're upfront with how you speak to them. And you say, look, here's the situation. We've all got cost of living stuff going on. I need to be here in the long run for you so I can continue to help you into the future. And I won't be able to do that if I don't make any profit to live on. It's so straightforward, isn't it? So I think, yes, now is a time you should be raising your prices. I think if you don't do it now, in 6 months' time, when inflation has done whatever inflation is going to do, but I suspect is going to be higher than we have seen in the past, and you're scrabbling for cash flow, it's going to be much harder to do that twice. You know, to do double the rise in 6 months' time compared to what you want to do now. I will always suggest to people to have that pricing conversation in a really upfront way with your clients. Really just explain to them where you're coming from, explain to them where the value is from using you. And that's the bit of the sales conversation that I think really is really important, is that the customer understands that you are providing so much more value than the cost of what it is to them. And if you can really drill down into what that value is and how you can articulate it. And for some people that's a return on investment, but for other people it might be slightly more intangible. You know, it's time saving, or it's freeing up your mind space so that they're feeling less worried at the weekends, or that they're not having to take time when they should be picking up the kids to be working on their website. That kind of stuff is the way to get you over the line with those sales conversations. But 100% everybody should be looking at prices right now.
Yeah, so Emma's just put something interesting in the chat. Is there a better time of year to have that conversation about price increases?
Oh yeah, that's interesting. Again, can be very industry specific. There are lots of ways to do price increases. So one strategy which I really quite like is taking a small proportion of your client base and trying it out with them. So you don't have to do like 1st of November, all of our prices are doubling. You don't have to do it that way. You could say, let's take a small proportion of the client base, try a new pricing strategy with them, see what the feedback's like, and then go from there. And very often when we suggest this to clients, what they find is that they do it with, they choose people that they like, they have nice conversations with them, they put up their prices by half of what they thought they could do, and it turns out that everyone's fine with it. Or they try doing it a little bit higher than they thought they'd get away with, and everyone's fine with it. And then it gives you a little bit of data to say, well, actually, I think I can continue to do that with the rest of the client base. So Emma, in answer to your question, what you might want to try, for example, is trying a higher price with new customers and keeping your current price with your long-standing customers, and telling them that and saying, you know, as a thank you, we've held your price for the next 6 months, but everyone else is going up. For your sort of business, timing, actually, I don't think there is one time of the year that's better than others. We get price increases from our software suppliers whenever it seems to suit them, and sometimes twice in a year. So don't think you can only do it once a year, and especially in times of high inflation, you may find that you need to drip feed some price increases twice, 3 times a year. You might find that you can do it in different segments at different times to help to ease that through. Or for your own sanity, you might say, actually, I just need to say, I was charging £70 an hour. Next week, it's £80 an hour, and that's it. End of conversation. So there are lots of different strategies you can use, but just use one of them, because if you're still where you are today in a year's time, and we've had big inflation, you are going to be losing money.
So I think that's all the questions that we've had. Unless anyone else has got anything they want to ask.
Oh, hi, Tory, it's Rob here.
Hi there, Rob.
I hope you don't mind if I squeeze in one final question.
No, please, go ahead.
And that was about IR35. I'm sure you're not surprised to hear me talk about that. So I know it's going back to how it used to be. I'm less clear about what it used to be, if that makes sense. Like, how far does it go back? Is the you know, I'm trying to understand the market as well. Is the market, does it understand, or typically markets say, well, I'm just going to ignore it and hopefully everything's going to be okay. So, you know, are the contract environments changing that you're aware of? So sorry for the complicated question, but where are we going back to, and roughly how do you see that impacting the market?
Yeah, no problem at all. Just for other people on the call, if they don't know about IR35, it's a very specific bit of legislation that talks about the way that subcontractors and contractors work together. And the IR35 legislation was to explain to people that were working as subcontractors that if they actually looked like an employee and talked like an employee and turned up at work like an employee with a badge on, they probably were an employee, and therefore they should pay tax and national insurance the same way that employees do so. It's been changed a number of times over the last 10 years or however long it's been. And the latest change was to put the onus onto the contractor to be liable for paying the tax and the national insurance for those people that looked like employees. And what that meant in the market was that lots of people who did have a contract, perhaps they were working in something like IT, and they were working for one employer as a contractor, they really were brought into being an employee because the big contracting companies didn't want the risk of having to pay tax and national insurance if they got caught out under IR35. It's basically fair enough, yeah, about that. So in the mini budget, they announced that this was going to be rolled back, and the onus would go back onto the subcontractor. So normally the small business that we would talk to, the onus goes back onto them to decide if they are within the scope of IR35 or without, or outside the scope of IR35. So the legislation hasn't changed. The way it's being interpreted, I guess, has. And Rob's absolutely right that that should have some kind of impact on the market. And what we might see is that those very large companies that are used to using lots of subcontractors may go back to doing that. But I'm suspecting what we've seen to date is lots of people being brought onto the books. I don't think those large companies are going to say, well, from tomorrow, we're going to boot you out and put you back on as contractors. The reason being is that those people have now got employment rights, now employees of a company, and it's a lot more complicated getting rid of them than it was getting rid of contractors, which is why they wanted you as contractors, right? So I don't think we can roll that back. I don't think anybody is going to trust this government not to change their minds again. Haven't had a great start to being able to rely on them. So I think right now nothing will change. And I think it will be like that for a good few months, possibly until the spring, actually, when we start to work out who the people are that are running the country, what they actually think about this stuff, and what they're actually going to legislate on. Because, you know, it's all talk at the moment. We haven't seen any legislation. We won't see legislation until the spring on any of this stuff. So I think probably, Rob, nothing changes. I don't see suddenly a big bunch of contracting type of companies going out and putting loads of new contracts on the market. I just think they're going to sit really still and wait and see what happens. That's my take on it. Anything to add?
No, I think I agree with you. I think because we've had so many changes on IR35, and unfortunately, especially in the last few days or yesterday, they're making changes. I don't think many in the industry it's going to change anytime soon, just because of that fear of the government changing policies again.
Yeah, I agree. Rob, have you got any thoughts on that?
I think, yeah, no, I think it's as you said, it is as you both said. My kind of hope would be that, you know, as you put it, all of these companies just decide out of nowhere, hey, we should really grow this market and offer hundreds and thousands of new contracts. But it's not realistic. And a lot of the IR35 stuff is an intuition or a feeling, as opposed to very rigid legislation and rules, or it used to be.
Yeah, absolutely. And you know, I keep on saying this, accountants, we don't like working without rules. We don't like not having anything written out that makes sense. But that is how this has been played out over the last 3 or 4 years at least, knowing that the HMRC guidance and the legislation do not match, and the calculators we have to check don't match what we know the truth to be. So we're in this very grey area anyway. You throw into that uncertainty about what the actual rules are going to be, and I don't think anyone's going to commit to anything just because there's so much risk built into it.
Yeah, so I agree. Very well explained. I appreciate it.
That's a pleasure, no problems at all. How are we doing on questions, Ali? Have we got anything else?
No, so we've got no other questions popped in the chat.
Oh, I can see
Oh.
Chandeep's got his hand up. Go ahead.
Oh yeah. Yeah, the question, I think my connection might have wobbled, so it looks like it's better now.
Yeah, it looks okay.
Okay, my question is, one of the things that has been on my mind for a while has been liquidations. I think so. So I'm just keen to ask: are you seeing a high number of liquidations or conversations around potentially insolvency, and does that continue to be a trend that is increasing?
It's a really interesting question. In our particular practice, we don't deal with retail, and we don't really deal with manufacturing either. So I think in our sort of area, we're not seeing an awful lot.
No.
But that's only because we work in a very specific kind of setting. I suspect we will see more in this last quarter of the year. I think the kind of bump that we had from CBILS and bounce back loans, that kind of lending that was available at pretty low rates is drying up. We're going to see much higher interest rates, and we're going to see some people who borrowed in a way that wasn't sustainable actually getting hit really hard in the lead up to Christmas. I'm assuming that the national insurance bit is meant to help a little bit with that, but I don't think there's enough in the package that we saw in the mini budget to help small businesses through a difficult trading period. Alongside that, we know that small businesses hold much less cash than they ought to, given the volatility of the world outside, and we've seen that dropping off actually. So at ZeroCon we were given some stats around that, where really small businesses have got so much of their cash tied up in the pockets of their debtors that most of them are trading really close to the line pretty much all of the time at the moment. I think these kind of shocks that we're seeing from a government that isn't being very stable will be enough to throw more insolvencies our way in the next quarter. And that's, I don't like to talk about the negative side, but I can't really see a way through that when the cost of borrowing to get out of the problems is getting higher and there isn't any protection coming back really from the government against that. I don't see how we get through it without some of those less sustainably run companies going to the wall. Yeah.
I think that pretty much sums up, I think, our experience recently.
Yeah, I mean, Ali's got experience having worked in insolvency practice before, much more so than I've got. And this is probably the worst times that you've seen. I don't know.
I think, yeah, personally, it's the worst time I've seen, just because we've come out of a pandemic. People's businesses, obviously, if they weren't sustainable through a pandemic, are still trying to struggle on. And then we've had the cost of living crisis. And then add into that, obviously, the government impacts. I think for some businesses, it is a bit of an unpredictable time, and there is always going to be liquidations on the cards. I think for any company that is considering or wondering if it is right is to contact an insolvency practice. Most of them will be able to talk to you about any specific queries and whether you believe it's the right time for you. Like anything with business, we don't want to go down that route for any business if it isn't the right choice.
Yeah, and what goes along with that is the absolute importance of having an up-to-date cash flow forecast, having up-to-date bookkeeping. It's the real basics of running a business. And I think now more than ever, having a plan and having some way of measuring yourself against that plan, so you know when you're starting to go off the margin, is absolutely essential, more so than it's been for years and years and years. And that's what we're really talking a lot to clients about at the moment, is just making sure you really know your numbers, because that's how you avoid slipping off into insolvency. Fab. Okay, I think Emma, bless us, had to disappear off. I know we've run over a little bit, so I think we're probably going to wrap it up. Thank you guys for your questions. That was brilliant. Really, really good to have those chats. We will do more of these. I think with this kind of uncertainty around, it's not something that we can just write you a blog about and share it. It's much more useful to have these conversations and to talk around them. So we'll keep you in the loop. We'll let you know when we're going to jump on another call, and we'll share this recording with you if you want to listen to anything back. So thanks so much for sharing your lunchtime with us. Really, really appreciate it. And I hope to see you on another one of these soon. Thanks. Bye.